You want to know the number one mistake I see investors make when they first get into multifamily? It's simple. They chase deals, and I mean any deal, every deal. A duplex one week, a 20 unit in another city the next week, and then some shiny new listing that a broker waves in front of them. They've got no direction. And here's the problem with that. When you don't know exactly what you're looking for, you waste months and sometimes years analyzing properties that were never going to work for you in the first place. Or worse, you get stuck with a deal that looks good on paper, but it doesn't fit your goals, and now you're chained to a property that basically bleeds you dry. That's why in this first video, we're talking about the foundation of multifamily success, your buy box. So what exactly is a buy box? Your buy box is the set of criteria that defines exactly what kind of property that you're looking for. This is the filter that every single deal has to pass through before you even waste a second running the numbers. It covers things like the vintage of the property, like what year you're most comfortable with, the unit count that you're actually targeting with the property, the submarket or neighborhood where you'll buy, the tenant profile that you want to serve, the purchase price range that fits your capital and financing options, the value add opportunities you're actually equipped to handle, and even your exit strategy, how you'll get your money back out of the property. Without a buy box, you're just wandering. You're letting the market, or worse, the broker, tell you what you should be looking at. And trust me, as a broker myself, I've seen exactly how that ends. The wannabes? Well, they'd chase every email I sent, every whisper of a deal. They were always busy, always analyzing, always asking me questions. But when it came time to close, they froze. Or worse, they bought the wrong thing. Now the pros, on the other hand, that's a completely different story. They tell me in one sentence what they're looking for. They'd say things like, "Hey Paul, I want a 1980s vintage property with 20 to 40 units in a working class area under $2 million with at least 15% upside on rents." Now that was it. I knew instantly if a deal was for them or not. They saved themselves time and they got the best opportunities because I knew exactly what to bring to them. Now that's the power of a buy box. It gives you direction, it gives you discipline, and it keeps you from stepping on landmines. So why does having a buy box matter so much? Let me give you 3 big reasons. Number 1, it saves time. Instead of analyzing 100 random deals, you analyze 10 that actually fit. That speed gives you an edge because you're not drowning in useless numbers. Number 2, it builds discipline. When you know your buy box, you don't get emotional. You're not swayed by a pretty brochure or a low list price in a bad market. If it doesn't fit your buy box, it's an easy no. It keeps you in line with your goals. The buy box isn't just about the property, it's about the strategy behind it. It's about making sure the deal lines up with your financing options, your management style, and most importantly, your risk tolerance and your timeline. Look, here's the thing. Multifamily isn't about buying every deal. It's about buying the right deal at the right time. And the right deal for you might be totally different than the right deal for me. That's why your buy box is personal. It's your lane. And if you stay in that lane, you will win. Let me show you exactly how this played out for me with my first deal. When I decided to buy property on my own, here was the buy box that I built. First things first, I wanted a specific vintage. I wanted a 1970 to 1980 vintage building. It was older, yeah, but solid bones. Properties from that area had plenty of upside, but weren't falling apart. Second thing I wanted to look at was the unit count. I was targeting 8 to 12 units. Why? Well, because that's the sweet spot where it's big enough to cash flow and justify the effort, but small enough that I could manage it myself while learning the ropes. Next thing I looked at was the Submarket, which was Sunrise Manor. I knew that area, had working class tenants and steady demand, and properties that were often overlooked by big investors. Then I thought about the occupancy. I actually wanted partially occupied because that gave me room to add value quickly by renovating and releasing vacant units at a higher rent. Then my purchase price. I capped myself at $350,000. That was realistic for what I was targeting and fit with the financing I had already lined up. Financing. My plan was to use private money for the acquisition. It wasn't the cheapest money out there, but it gave me speed and certainty. I could close quickly and not get bogged down in bank red tape. I had a CapEx plan that I thought about. I wanted minor interior and exterior renovations, stuff like new flooring, paint, fixtures inside, plus some little bit of curb appeal. Nothing major, but enough to lift the rents and attract a better quality tenant. Then it was my refinance timeline. My plan from day one was clear. 12 months to stabilize the property, raise rents, and execute the CapEx. Then I would refinance into a traditional loan. That way I could pull my equity back out through a cash out refi. After that, I thought about my exit plan. This was not a forever hold. My timeline was maximum 5 years. After refinancing and holding, the plan was to sell and trade up into a bigger property using the equity that I had created. Obviously, I had to think about management. So self-managing it at first was what I was going to do. Why? Well, because I wanted to learn. I wanted to know how to screen tenants, how to handle maintenance calls, how to collect rents. That knowledge became the foundation of every system I built later. Now, here's the key. I looked at a lot of deals around that time, but if it didn't check those boxes, I didn't touch it. I passed on shiny new listings. I passed on properties in sexier parts of town. I stayed disciplined. And because of that discipline, I ended up with a deal that fit me perfectly. It wasn't the biggest, it wasn't the flashiest for sure, but it was the right deal for me at that time. And that deal, it set me up to keep growing. So here's the lesson. If you don't have a buy box, you really don't have a strategy. You're just chasing shiny objects. But once you define your buy box, every deal becomes a quick yes or no. You save time, you build confidence, and you set yourself up to actually execute instead of spinning your wheels. Now, I want to hear from you. Drop a comment below and tell me what's one piece of your buy box you already know. Maybe it's the unit count, maybe it's the submarket, maybe it's the price range. Whatever it is, post it below because I want to see where you're at. And don't forget, before you leave, subscribe so you don't miss the rest of this series. Like this video so it gets in front of other investors who actually need to hear it. And stick around because in the next episode, I'm going to be breaking down one of the costliest mistakes of all: overpaying because of emotion or hype. Now, that one mistake has taken down more investors than I can count, and I'll show you how to avoid it.